we've got the jargon bin to go over.
We do. It's week 4 of the Jargon bin, I believe.
It's exciting.
Yeah, let's get right into it. We are talking about cash on cash return. Last week we talked about internal rate of return and equity multiple. Cash on cash return is the kind of third return metric that you'll see on Gray Capital pitch decks in regards to overall investor interest in the deal. So let's start with cash on cash. It's rather simplistic. So let's start with that basic understanding. What exactly is cash on cash? And can you describe or mention to myself and our listeners the equation to get to cash on cash?
Absolutely, because it's the absolute easiest formula there is in, I think, real estate investing. And so the main question that the cash on cash is asking is, how much cash did I receive this year compared to what I invested in? So the simple formula is dollars received, as in cash to put in your bank account or your pocket, divided by your dollars invested. So cash back to you divided by what cash you put into the deal itself. It's simple as that. Now, there's nuances. There's people look at it different ways. People confuse it with other terms. But simply, again, it's the cash that you receive divided by the cash you put in.
Wow, that's simple. So it's not the total money you're making, and it's not the speed of return. Rather, it's the income yield that you're getting today.
Yeah, exactly. So like some of those other questions or answers would be equity multiple, be the total money. The IRR is kind of like the speed of your return. Your cash on cash is your actual cash yield, your income yield today.
Wow. Let's go next layer of depth into cash on cash. I want to talk about how cash on cash is levered income yield on your equity. And so what an investor is actually receiving is that free cash flow. But how does the property kick off this cash flow following its total revenue generation? Obviously, there's operating expenses. Kind of talk about how that cash on cash return, that final product, gets distilled down to our
So if
investors.
you're looking at an income statement, and I think that's what you're getting at, is really kind of which is the line item, what's the math, and it's really simple. All your income, your revenue, you minus expenses, which that would be your net operating income. You take your net operating income, and then you deduct debt service payments, principal and interest, but also any management fees. I mean, it's the true, net cash flow. But we're also very simply, if you're an LP investor, it's that cash distribution that is sent from the property that LP investor receives.
Right. Awesome.
So it doesn't include depreciation. It doesn't include anything like that. That's on the paper or a balance sheet, issue. It's truly after expenses, after debt services, after management fees, what cash is available to distribute, and then that cash that is actually distributed. It's different from just the net cash flow because you can receive net cash flow, where the property can be producing net cash flow, but that sponsor may retain some of that net cash flow into reserves. There may be a month where there's positive net cash flow, but the sponsor decides to withhold distributions to build up reserves. That would be a 0% cash on cash.
Understood. As an investor yourself and as an owner-operator, the ideal cash on cash return in a multifamily acquisition, I've seen folks confuse cash on cash with preferred return, with an IRR, with an equity multiple.
Yeah.
So let's talk about ideal cash on cash and how it is not preferred return and how they differentiate themselves.
Yeah, well, and this is the teaser. So we're going to be talking about preferred return on next week's Jargon Bin episode. So if you want to learn more about preferred returns, you're going to have to tune in for next week's episode. You've got to subscribe to the Gray Report, obviously. But so the preferred return is essentially a return in a threshold in the economics waterfall where an LP investor will receive a certain annualized return before distributions are split between parties, typically, again, the LPs and the GP. So an 8% preferred return, I need to have received that 8% annualized return before the GP starts getting into the money and we start splitting cash flow. And so there can be an 8% preferred return, but the cash on cash return may only be 6%, leaving that delta. Again, it doesn't matter that the preferred return is 8%. The preferred return can be 15%. The preferred return can be 20%. It doesn't mean you're going to receive any of that money. That's just a threshold to start the next tier of the waterfall. Cash on cash is simply, this is the money that's available and we're going to be able to send it to you.
Cash on cash, I think very similar to IRR, can always ebb and flow as you're underwriting a project.
Yeah.
But cash on cash in the midst of a hold period, in the midst of an investment, can increase and decrease year over year, month by month, based on some of those overall revenue generation expenses at the property level, at the asset. So as an investor, if you hear, oh, there's an average cash on cash of 6%, I guess lay that out for us with the expectations of the LP. 1 year you may be able to receive 3% cash on cash, while the next year maybe you get 10% cash on cash.
Yeah. No, I think it's the average cash on cash metric is important to compare different investments, but it doesn't tell the whole story. You really have to look on annualized cash on cash. Because to your point, there could be 3% cash on cash in the first year, which is below what many investors may like to see, depending on the risk profile and the strategy of the investment. There could be 0%, or there could be a high degree of cash on cash. Maybe there's an interest-only period that burns off that allows for higher cash on cash earlier on.
You mentioned an interest-only period and its impact on the overall cash on cash returns. Leverage and debt and the way that we are financing our projects can really materially impact overall cash on cash returns to our investors. Just talk briefly on the impact of how you are establishing your financing, or what kind of debt you're placing on the asset, and how it impacts overall cash on cash.
I think bottom line, the leverage is hugely influential into determining what that cash on cash could be. I mean, if you have double the equity that's required for a project, your cash on cash is going to get cut in half. Conversely, if you need half the equity, your cash on cash is going to double. So the more leverage that you use, theoretically, the higher that cash on cash is going to be. And that could impact your total return because you're bringing less equity on, but your cash on cash is significantly influenced by the amount of leverage, but also interest only. Typically, especially like in an agency loan or a bridge loan, there's a certain amount of years where you only have to pay interest. You don't have to pay down your debt or principal at the same time. This can accelerate cash flow, but it's good to know you're not paying down the principal of that loan balance over that period of time. Higher cash on cash earlier, kind of going back to our IRR conversation last week, more cash on cash earlier on, you receive money quicker, can influence that overall IRR and total return profile as well. So leverage is key. And again, the same property, the same investment purchased at the same purchase price can produce vastly different cash on cash yields depending on how you lever it.
Interesting. And you had mentioned the principal payments, so the pay down of the principal balance of the loan.
Yeah.
Those principal payments, those do not get equated
Exactly. Correct. And this is where I do get some confusion sometimes. I'll talk to, LPs, which surprised me, but also GPs who want to include some of the mortgage pay down or paying principal as a part of your cash on cash return. It's really a balance sheet component and a component of total return. Well, eventually will turn into total return, but you may be paying down that principal, and that does start to slightly de-risk the asset because, again, you just have less liabilities associated with it. But it's an unrealized return. You're not actually realizing it, where cash on cash is a realized return. It's the money you're actually putting in your bank account or in your pocket, not dollars that are going down to pay down debt service. That's important to know that when you are amortizing a loan, but it's really not a component of cash on cash. The reason why it comes up is because when you start amortizing after an interest-only period, cash on cash declines. It goes down, and investors often ask sponsors, why did our returns go down? Why did my cash on cash drop? And the sponsor's response is, oh, well, now the loan is amortizing, but wait, that's a good thing, because if you actually add the dollars that were amortizing, your return is your cash on cash plus that principal amount, based on your percentage of equity. And so they kind of spin it as a positive. And not that it isn't positive, but it's not a cash on cash return.
It's got way more of an impact on the total return, the IRR, the equity multiple.
Exactly.
Understood. Let's get to our last level of depth in regards to cash on cash. And I've seen this occur in our projects. You have a capital event. Let's just say a refinance. You're able to return a certain percentage of your investor's capital. And so now you have an original capital balance versus a current capital balance. How does the cash on cash calculation alter or changed based on original capital invested versus the current capital balance following a refinance.
Yeah, no, this is a really important component to understand, and I really like looking at both. You're familiar with our underwriting model, and we have both an original and a current cash on cash metric, and the reason for that is we love the idea of getting to a point of infinite return. And the only way you can get to an infinite return is basically if you have $0 in the project, and then when you're taking your whatever you receive divided by zero, it's essentially infinite, or your calculator breaks.
Yeah.
Obviously, you had risk up front, and there still is always some liability that can be attached. But the way we get to that infinite return is if you're looking at that cash on cash calculation, not just by what you put into the deal originally, but how much money you actually still have left in the deal. So by taking it on current balance or your current capital account balance, you're factoring in the capital that has been returned to you. So let's say, for example, you invested $100,000 into a project. You're receiving $8,000 a year. $8,000 divided by 100, that's 8%. 8% cash on cash return. That's great. Let's say the property refinances, and through that refinance, $50,000 is able to be returned to you. That's great. It's a return of capital. That's a return of 50% of your invested capital of your equity. Your updated capital balance now shows $50,000. So now if you take that $8,000 divided by $50,000, all of a sudden that cash on cash return is 16%. Now, I think it's important to look at it both ways. One, just relative, relatively what I put into the deal, keeping things consistent, using the original capital balance and saying, hey, look, the deal's doing 8%. But I think it's always important to understand, how your money is working for you and your actual dollars that are in the deal. And the reality is, if you look at the money that you have in the deal divided by, or the money that you receive divided by the money you have in the deal, you do see a significant increase in cash on cash. I don't think that, I think it's always important to understand both. And that's why in our models, it's very clearly labeled the difference between the two. But I think it's important to look at it because, again, there have been examples, and I've done deals like this where we've been able to pull 100% of the cash out. There's even been deals where we've been able to pull 100% cash out more than once and still own it. So, we put in, $1 million. We receive $1 million back from a refinance. And then a couple years later, we can receive another $1 million back. Now, the cash flow that we receive, again, we can look at it as, that balance, the cash flow based on the original investment. And again, that's a good kind of relative marker of what it's still throwing off. But the reality is that our money is no longer invested in the deal. We don't have any money in that project. The chips have been completely taken off the table. So it's not wrong to show that infinite return. It's just, again, it doesn't really work that well on a spreadsheet.
Yeah. Right. That's interesting. The cash on cash metric, obviously, it can be misleading. It can be slightly confused. But at the end of the day, it is largely driven by overall leverage or debt on the asset.
Yeah.
And then, I think the idea of the interest-only period and the use of financing, if you're an investor, you see would be more robust or larger cash-on-cash returns, more likely, and then dwindling across the whole period as that amortization begins. It's a good thing for, I think, our LPs to understand. But then at the depth of this conversation, the difference between the overall cash-on-cash returns based on original capital balance or existing capital balance, I think that can really kind of create some confusion. All of a sudden, you're an investor, you see, we're getting a 16% cash-on-cash return. Holy cow, this deal is doing fantastic, when in reality, it's basically doing the exact same as before a refinance. So it's just all about a perspective and a lens. So let's close up the cash-on-cash conversation. What do you think about, when you think about a 10% cash-on-cash return? Is that high? Is that expected? What do you think?
I mean, it's all relative on the deal, right? The risk. But in today's market, cash on cash, if you're a common equity investor, a 10% cash on cash return is an incredible return. Okay. Most cash on cash returns that we're seeing, out of the average cash on cash, is typically between, call it, high sixes and 9%.
Okay. If you saw that 10%, What are you asking yourself as an investor?
Well, I'm asking myself what am I missing?
Okay.
I'm also asking, am I investing in common equity? Am I investing in some sort of preferred equity? Because again, that's just a high level of cash on cash. Now, if it's preferred equity, it's typically it's consistent returns because you're typically just clipping that coupon. I'm clipping a high preferred return. But there's ways that you can manipulate cash on cash, and people talk about, and we talked about last week, how you can manipulate IRR. Well, cash on cash is one of the methods how you manipulate IRR. Again, we talked about front loading that cash flow. So one of the easiest ways to manipulate, not just cash on cash, but the overall, also the total return of the deal, is if you accelerate any of that growth in the first year. And again, I used to invested in deals as an LP, and the big questions I had, this is when I was starting out, is there's this discrepancy of where the T12 is, where their actuals are compared to where like month one and year one of the sponsor's pro forma. And I noticed that basically the pro forma has all of the work being executed, and basically rent's already re-signed, or the lease is already re-signed at the new pro forma market rents in year one. The reality is it takes some time, but by front loading all that growth in year one, you're compounding on a higher basis of growth, and so you can produce a higher cash on cash throughout the overall hold period. But what it's missing is that potential period of stabilization. So other ways you can manipulate cash on cash is, again, using heavy leverage, your interest only periods, and then what your rent growth assumptions are.
Yeah.
If you have 0 or the 3% rent growth, well, that's considered very conservative. If you have 5% plus, well, that could be seen as pretty aggressive, depending on the deal, depending on the market, et cetera. So there's a lot of ways to manipulate cash on cash. The question of what is a good cash on cash return is evolving. It's different. It's changed a lot. When I started putting these deals together, we wanted to see cash on cash never dipping below 8%. Most deals we would, and again, we structured deals a little bit different when I got started. Typically, we'd be closing on a bridge loan while we put a permanent HUD loan in place. And we might be on that bridge loan for a year. And that bridge loan was interest only. The HUD loan would be fully amortizing. But we could achieve double-digit cash on cash often in year one because we were buying properties at kind of 6.5% to 7% cap rates, doing a value add, pushing up some revenue, and that would produce strong cash on cash returns. Again, double-digit cash on cash returns. And then once we refinance, put an amortizing loan on, it would drop it down, but it would typically drop it down to like 8.5%, 9%.
Interesting.
And so still solid cash flow. Those days, though, are gone. Interest rates are higher. Cap rates are still lower. So like I said, we're seeing cash on cash typically out of the gate between 5 and 6 is pretty normal, like to grow it to 8%. Some deals, it's hard to even achieve that, but that's what most deals are looking like today.
And now we're out there searching high and low for
I don't think we're going to win it. So again, don't get too excited, everybody. But we were close. We were close on a deal that had some just great cash on cash return. It was partially driven by the cap rate. It was a little bit more of a market that not as many people are going into, but it got me really excited. Again, it wasn't that same level of cash on cash, but it was really good. It would average about 9.5% almost, and it hit 10% in some years, and we just haven't seen those types of yields. Now we have like properties in our portfolio that are crushing it on cash,
right?
And again, why is it? It's because of leverage.
The financing. Yeah.
Villas on Fur, which is one of our more successful properties that we own, partially because where we bought it, but it's how we financed it. And we've gotten great net operating income growth, NOI growth. But it's because we were able to put this HUD 223F loan at a 2.7% rate, amortized over 35 years, and essentially from when we bought it to when we put the loan in place, the leverage ended up being bumped up to kind of like the low 80%, which is a high degree of leverage. We've never levered anything that high, but the cash flows and the growth really supported it. And it's been producing, 14, 15, 16% cash on cash returns, true based on original capital cash on cash returns, they'd be close to 20% cash on cash on existing capital accounts. And it's a Class A property that we didn't have to execute value added. Right. So you can get high cash flow in surprising places. But again, the reason why we're able to cash flow villas is because of leverage. We've looked at similar deals, same purchase price,
totally different debt.
Totally, the leverage is completely different. We're having to bring double, almost triple the amount of equity, and the returns are unsurprisingly half or less.
Let's tie a bow on cash returns. It's not a return metric that's quantifying how fast you're getting your money back. It's not a return metric that's telling you how much growth or how much money you're going to be getting back, but rather it's a quantifier and a metric of income that is measuring how much cash you're receiving based on your initial capital balance or your existing capital balance. As somebody that's investing in a private placement in real estate, you should be asking yourself, how is this cash on cash metric being generated? Where is the income coming from? What is the leverage that's driving it? Is there an interest only period? When does the loan begin to amortize? And then what does that total return look like? And how does that cash on cash get you to that total return? Anything else that people should know about cash on cash return that maybe we haven't already mentioned?
I just think cash flow is just like the lifeblood of any deal. And so just a healthy amount of cash flow, it provides a large kind of margin of error. I like to see healthy cash flows. We're cash flow investors. We feel like even though sometimes you have to buy a high cap rate deal that may not have the highest chance for appreciation to receive high cash flow, I found finding a really well balanced deal with good cash flow will always have a market. It'll always have some liquidity, and find more success when your deal's a little fatter and it's not as skinny. Again, low cash flow means skinny. That means you're closer to your debt service coverage ratio kind of limit, which can be another jargon bin term. But a lot of cash flow means the deal's healthy, but you just don't want to confuse it with. You also have to equate it with risk, and get a higher rate of return usually also means a higher degree of risk. So understand what you're getting into, how that cash flow is derived, and understanding the assumptions.